Okay, good morning, everyone. Thank you so much for joining our webinar today. My name is Mona Iganian. I'm with the Autonomous Vehicle Innovation Network, or AVIN, and it's my great pleasure to welcome you to the webinar today and just to say a few words before we turn it over to our guests. So today's webinar is the first of a series brought to you by AVIN in partnership with Borden Ladner Gervais, or BLG. And recognizing that due to COVID-19, companies are facing a more cautious and risk-averse investment landscape, we felt that this was a very timely and important topic to address for companies in our ecosystem. So we're very happy to bring this webinar to you today, and we couldn't have done it without the dynamic team at BLG, our knowledgeable panelists, and our supportive team at OCE. So thank you so much in advance for helping to make this webinar happen. I'll say a few quick words about AVIN for those of you who aren't familiar with it. AVIN is the Government of Ontario's initiative around the future of automotive and mobility, and it's a key component of the Driving Prosperity Plan, which is the government's 10-year plan to ensure the growth and competitiveness of Ontario's automotive sector. And as the sector evolves and it converges with the tech sector, Ontario is really at the forefront of this transformation, and it's emerging as a global leader. So through various technology development programs and a network of province-wide support, AVIN is driving the commercialization of advanced automotive and mobility solutions and supporting the testing and piloting of these technologies so that we as a province can become early adopters and reap the economic and social benefits of these technologies. AVIN also drives thought leadership activities that push the sector forward in Ontario. So that includes research and analysis, convening stakeholders, and hosting events, much like the one that we're here attending today, just in order to raise awareness of the opportunities for Ontario companies and partners. So you can learn more about AVIN at our website. It's avinhub.ca, and we'll have it up on the screen for you. But please feel free to reach out if we can provide any more information on the program. So without any further ado, I'll hand it over to our webinar moderator, Manoj Pundit. So Manoj is a partner with BLG, and he's going to introduce our guests and kick off the discussion. I just want to mention one thing. So you should see at the bottom of your screen, there's a Q&A function, and that's intended for you guys to really use, and we encourage you to take advantage of asking questions throughout this webinar, and we'll be sure to do our best to answer them. So that's it for me. Over to you, Manoj.
Well, thanks Mona. Thanks very much to you, AVIN, and the entire AVIN team, including, of course, Red Kadri, who heads up the organization. I'm really pumped about doing this webinar because the work that I and a number of BLG lawyers do, focuses on advising tech and innovation companies and also venture investors across a number of verticals. In fact, BLG has significant depth in advising tech companies, and we do this through our firm's numerous industry-leading sector initiatives, including autonomous vehicles, fintech, life sciences, just to name a few. We also have a program called Startup and Grow that's dedicated to assisting our founder-led client companies to get off the ground. So just before getting started with our dialogue with our panelists, I wanted to also take the opportunity to quickly make a few observations about our marketplace, particularly our connected and autonomous vehicle sector. It's no secret we have several ranked world-class universities for computing science. We have, the fastest growing tech hub in North America. We have the second largest auto sector by number of vehicles produced every year within North America. And then as a result of these and a number of other factors, we have one of the highest concentrations of companies dedicated to teaching cars to think, from AV technology, AI and connectivity, mobility, cybersecurity, quantum computing, and the list goes on. And turning to our venture investor sector, without which most, if not all, the entirety of the companies in our tech ecosystem could not exist. Canadian venture investment in 2019 was over $6 billion. That's across all sectors: ICT, life sciences, clean tech, etc. Now, in the first quarter of 2020, we saw over $830 million of venture investments across 117 plus deals. And while that's impressive, it does represent a bit of a pullback, I think about 7% from the same quarter in 2019. Of course, these numbers don't fully reflect the impact of COVID, since the lockdown in our business sector didn't start until well into the last couple of weeks of the first quarter. We'll see how the numbers shape up for the second quarter, but COVID will undoubtedly have an impact. We'll also learn, of course, in this webinar what the current state is and how best to navigate in these turbulent waters in this dialogue with our panelists. So without any further delay, I'd like to ask each of the panelists to take a couple of minutes and introduce himself or herself and their respective organizations. So starting with Shiva Bhardwaj from Pitstop Connect. Shiva, tell us about yourself and your company.
Yeah, thank you. Excited to be here. So I could give you guys a background about how we started Pitstop. It was founded in 2015 based on two core experiences of mine personally. The first was growing up in family-owned automotive service centers, and I got to experience how the automotive industry, and the vehicle specifically, was following the trend of Moore's Law. There's a lot of differences between how the vehicle follows it versus regular technology like laptops and such. But in observing that, I got really fascinated with how these electrical systems could control such a complicated mechanical system. And so I went to Waterloo for electrical engineering. And what I was able to do from that experience is get really deep into designing these boards, like multi-layer boards with a focus on power electronics. It gave me an experience by working with NVIDIA, in which I got to see, and this is the second core experience, which I got to see how in the tech industry, when a product is launched, let's say in a laptop, within weeks, that tech company will get access to failure reports around that product. And it enabled the company to push out firmware updates at a rate that pretty much resolved all the problems that were experienced initially when these products were launched, were kind of resolved within a few months of its launch. And whatever could not be fixed was then iterated upon the next hardware version. And I realized that automotive does not share, even though the vehicle has so much computation capability, none of that information flows to the supply chain to drive a similar type of efficiency. And that's how Pitstop was founded. And our goal is to move the auto industry from reactive to predictive.
That's great. Thank you very much. We'll look forward to hearing more. Next, we'll turn to our investor panelists, and starting with Sanjeev Sament. Sanjeev, can you say a few words about yourself and round 13?
Absolutely. Hi, everybody, and thanks again for the opportunity to be here. Very excited. I'm a partner at Round 13 Capital, and Round 13, for background, is kind of a more traditional venture capital fund with about $260 million of management on the venture capital side. I started a new fund under the Round 13 banner called Round 13 Growth. My background previous to that was 20 plus years of investment banking, and I've had the good fortune of dealing with a lot of the public companies in this country, ranging from Shopify to Kinaxis to Lightspeed, all the way through the rank, and had the opportunity to lead a lot of the IPOs in this country and do a lot of the cross-border M&A work. I felt there was a kind of a need on the late stage growth equity side for, one, the skill set, and two, capital. And so earlier this year, founded this new fund called Round 13 Growth, and our focus area is really late stage growth opportunities. So we're really looking for companies that have already scaled or are scaling late in the cycle that wouldn't be considered kind of venture stage anymore. Really, later stage companies where we're looking to kind of add some jet fuel to get to the next stage. So that's really our focus. We're a new fund on the growth side. And we've closed on the first $100 million there, and looking to do a second close in the next while. So again, I appreciate the opportunity to participate here.
That's great, Sanjeev. We'll turn it over to Ray Sharma from Extreme Venture Partners. Ray, take it away.
Thank you very much. I started my career in equity research, working for a firm called Credit Suisse First Boston out of San Francisco. I have a long-term professional focus on mobility and mobile technologies. In 2001, my title when I was living in San Francisco was Vice President, Mobile Internet Devices and Applications. I was one of the most specialized analysts in the world. And my firm was a very active underwriter. We led the Handspring IPO, which were the founders of Palm. We co-led the first RIM billion-dollar financing. We led IPOs locally like 724 Solutions, which was both one of the most successful and unsuccessful IPOs in Canadian history. Sajivo, remember that one? I did a bunch of industry firsts, like hosted the first investor conference for smartphones in 2007, 2008. When I shifted gears after spending some time at a bank-owned dealer in a boutique, I started a firm called Extreme Venture Partners. We had a focus on mobile apps. We built a software development lab called Extreme Labs. And over the course of the last 10 years, we funded about 110 companies, all seed and lead stage. Pitstop is one of the companies we helped fund. We've been really lucky in terms of exits. We've had some exits to companies like Electronic Arts, Google, Apple, and a bunch of others, which have been really great. We continue to have a long-term focus on mobility, mostly on the analytics layer and the application layer. And I also have founded and funded a bunch of companies, about 15 directly myself. So that's my background.
Great. Thanks, Ray. You're obviously a veteran in the sector, so it's great to have you aboard. The last but not least venture investor on our panel is Eva Lau. Eva, I think you're back on. You're having some tech issues, but I think I see you're back on. So thank you for joining. Please do introduce yourself. Please also tell us how you got this or came up with the unique name, Two Small Fish Ventures.
Oh, wow. Okay, that's going to be taking the whole hour. No, I'm not going to take it the whole hour. So I am the founding and general partner of an early stage startup VC fund here in Toronto called Two Small Fish Ventures. Before I became a VC, I was an angel investor, kind of like promoted to be a VC now. I manage a $12 million fund here in Toronto. And before I became an investor, I actually helped my husband to build his company. He's the CEO and co-founder of Wattpad, the largest consumer internet company here in Canada. On his platform, he's entertaining 80 million monthly users right now, sharing over 500,000 of new fictional stories chapter every month. Over 500 million of stories have already been shared, and I was one of the first employee in his company to help him scale the user base from tens of thousands of users to tens of millions of users. So Two Small Fish Ventures actually has two meanings. One meaning is that it's two small fish, is me and my husband, co-founded this investment vehicle. And so we just two very small fish in this ginormous blue ocean of innovations, and that's how we see ourselves. But at the same time, it's also, inspired by a biblical story of, Jesus feeding 5,000 people with only 2 small fish and 5 loaves of bread. So I imagine that if I, put myself out there and making my capital and experience relevant to the ecosystem by, just sharing with them, perhaps we can feed 5,000 portfolio companies and nurture them into, big fishes, in the ocean and massive success in the ecosystem. So that's the story behind Two Small Fish Ventures.
Great. Well, welcome to all of you, and thanks for joining again. So what I would like to do is to ask Shiva Bhardwaj to tell us a little bit about your funding history and some of the challenges you've had along the way. You've obviously been successful by anybody's measure in raising funding since inception. But tell us about the journey and some of the challenges you've had from business formation, bootstrapping, external financing, and possibly even some strategic financing, which may be in the works.
Yeah, for sure. So when we founded the company, we came right out of school, so right out of Waterloo. So no experience with building a business at all. So initially with raising money, it was about someone believing more in myself and my team and the idea that we had, more so than maybe the specific business model that we were laying out. And we're lucky to engage with Ray and his team and build a relationship. So it takes time, especially in the early days. I guess it always takes time. It takes months to years to build these relationships and show that over time you can make progress. So our first round, we did about 750,000. It was led by Extreme Venture Partners, but we had Mars contribute to that, BDC. We also were a part of the Techstars accelerator. This was based out of Detroit, Michigan. So that initial seed funding helped us hire our first employees, but also get some exposure while we're in Detroit and pushing our product and idea to the big automotive firms. And then over the next, I think, 2 to 3 years, we were really heads down focused on specific business models we could deploy with our predictive maintenance technology. So being able to actually drive revenue from the ability to predict vehicle failures. And so we started with helping service centers and dealerships increase customer retention. Over that period of time, we were able to prove at minimum a 15% increase in revenue for these companies. And it was based on, if you tell a driver what they need to do for service based on what their car is telling them, but also based on the insights generated from these dealerships from fixing thousands of cars before, it's easier to trust and say, okay, I'll come and do that service because of the data provided behind it and the proof. And so that proof led, on the worst case, about 15% improvement in revenue, and in the best case, about 50%. So that's a minimum about $300,000 in additional revenue over a 12-month period for these businesses. And then in parallel, we're also testing the use case of our solution with fleet companies. And from that, we've been actually more recently gotten a lot of traction with that market and helping fleets increase vehicle uptime, which has a future with autonomous vehicles and things of that nature, where autonomous vehicles will be a lot more fleets than individual ownership. And so this ability to predict what's going to happen, when it's going to happen, and share that data with the supply chain is very key. So that led to our seed round. So I guess the first was more like a pre-seed. Then we did a seed round of about 1.3 million, which was last year in January. And that kickstarted this fleet business that we've been growing with. We secured a number of partnerships. Luckily, we were able to work with AVIN to hire some of our core data science employees. So our head of data science is a PhD, and then we have some individuals that work on his team that come from either masters or bachelors in physics and things of similar disciplines. And we were able to leverage the Talent Edge program from AVIN. And then with one of our partnerships, which was with a big fleet telematics company, AVIN was able to fund a joint project. So it's a multi-million-dollar project, and AVIN funded a third of it. And that kind of kickstarted this strategic relationship with a very large industry tier 1 supplier. We're about to secure a Series A through that relationship. And so it's in the works. I can't announce the details yet, but we're really lucky to have that opportunity during a time like this. But it shows and speaks to the technology we built and the future that we're going to really impact with the auto industry.
That's great, Shiva. It sounds like you've got the full range of types of investments. So you're clearly already a veteran of raising capital. Turning back to our investor panelists, Ray, Sanjeev, and Eva, I'd like to ask you to tell us a little bit about what's happening in the current venture market for funding. And maybe you can tell us a little bit about what's happening in terms of specifically, obviously, the 3 months since we've all been under a lockdown due to COVID. Can you tell us a little bit about any trend lines that you're able to identify, and generally speak to what venture investors' attitudes are towards new companies as well as their existing portfolio companies, and what you think the sort of the lasting effects of COVID are going to be, at least for you know, sort of the medium term or the foreseeable future. So there's a lot to unpack there, but I'll start with you, Eva, if you could give us your thoughts.
Of course, I'm happy to share what I've been seeing in the market and, you know, kind of like sharing how I see it will be going. In the last few months, during this, you know, lockdown period, I would say that the reaction from the investment community is actually very polarized, meaning that there are a certain group of VCs, they are, you know, ultra conservative because they may be at the tail end of their funding commitment. So their job is to basically protect all of their existing investments. So they don't necessarily look at new investment. I actually have have firms that I try to, you know, produce to them, and they say, you know what, they have made decisions in the next 9 to 18 months. They will be extremely cautious when it comes to new investment because their number one job is to focus on their existing portfolio. You know, so that's one extreme of it. And then on the other side of the scale is that there are a lot of VC. They are actually very bullish in terms of, wow, this is the inflection point of the next generation of tech startup coming up because of the of COVID. You know, people, you know, the trend in digitalization is just goes so fast that governments are looking for solutions. You know, education is looking for solutions. Healthcare is looking for solutions. FinTech is looking for solutions. So all of a sudden, you know, that whole the trend of actually innovation has accelerated so much faster because more and more being adopted. So all of a sudden, you have this, you know, scale, you know, on this side of the scale of investors that they are just kind of like, let me just hunt for deals. Let me just look for the next best thing, the next Uber, the next Airbnb coming up from the ecosystem. So they are actually very active. But having said that, the general consensus is that, you know, when it comes to valuation, unless you are a really hot deal, meaning that you have ginormous potential, great traction, chances of you actually raising a flat round or perhaps a down round is actually very high. One of the report coming out from Silicon Valley, from one of the very reputable VC firm and NFX over there, they are basically seeing a trend of 20 to 30% reduction in, decrease in valuation. And they actually expect in the next 12 to 18 months, the trend will continue on. So what that means is, you know, fundraising is going to get harder and harder. A flat round is the new up round. But at the same time, if the company actually has good traction, whether it's adoption, whether it's a revenue, anything that is showing that, you know, the investor that you are on the uptrend, those companies are going to be, basically entertaining multiple term sheets, and I've seen those. So I think, you know, what I, come back to the very first point is I'm seeing a very polarizing type of activities that's happening right now in the ecosystem. There will be a lot of casualties, but there will also be a lot of darlings coming out from this era.
That's great. Ray, you are unique in that you've got a long history in tech generally. I know you're very focused on mobility as well. So you've got a number of companies in your portfolio, plus you've got capital invest. What do you have to say about the current climate?
Well, we do have some companies that have, unfortunately, their revenues have gone literally to zero. We have this fantastic company called Locify, which provides local guiding services, been profitable from year one. The lady entrepreneur our CEO who runs it, she's amazing, but she's one of a handful of names that have had revenues unfortunately drop to zero. What's interesting from a financing point of view, Manoj, is that if you look at the capital in the world and you separate it between permanent capital versus fund capital, you have a very distinct difference. Permanent capital is like a hedge fund, where if you're going through a market correction and all of a sudden 5 or 10% of your fund in privates has now become 20% of your fund in privates, that causes significant issues. Those people back off from the market. Fund capital, people going from where we have 3 funds, we go to fund 4, fund 5. We have an incentive to deploy that capital over a couple of years. Corrections like this are opportunities to invest in companies. Something that Eva mentioned, alluded to, is that the best companies emerge from recessionary environments. The best funds are, if you look at vintages of funds, the best funds there's a high correlation also with recessions and vintage fund performance. There's also a dichotomy happening between growth, private equity capital, which is one of the biggest trends in finance, is this new wave, which is somewhere between private equity and venture capital. We're in the midst of closing an exit right now, which is to a big US growth private equity firm. It is by far one of the biggest trends in finance that everyone on this call should be aware of. And there's also a bit of a split between public and private markets. The public markets are very strange. You have a small group of big cap tech companies leading the index upwards. And then you have a bunch of these Robinhood stocks, companies that are going bankrupt, that are going up 50% in a day. You have to look at some of the broader indices to get a feel for what's happening to the market overall. But ultimately what you're seeing is you're starting to see, at least during the depths of the correction, you were seeing deals in the public markets that were better than the deals in the private markets. So what happens is private investors tend to shift focus and do things called PIPEs, public investments, private investments in public entities. And what they do is they'll see a 16% dividend yield for a company in the public markets, and they'll rather buy that than a private market opportunity. So we go through all these shifts, and that's kind of interesting. The market is definitely not homogeneous, but with regards to Manoj's question, your question about the biggest impact on the longer term, many of the trends that I see happening right now, I expect them to mean revert to normal. A couple of the trends that do stand out are this call itself as a metaphor for this reassessment of the whole home office versus corporate office relationship. It's ironic because WeWork went through what it went through, but there will come a time after WeWork gets through its stuff where what they have is something that is quite interesting. Maybe they need to change their model, not go to a monthly termination period. And also there's a culling of the herd happening. There's, OpenTable is estimating 20% of the restaurants are going to be shut down. Some really big signature places here in downtown Toronto, everything from Crocodile Rock, Marche, they're shutting down. So there is a bit of culling of the herd. The companies that don't have more than 2-3 months of cash are not going to be around. So there's going to be an effect what happens when those companies reincarnate. For me, the last point I'll make, Manoj, is that with 5G just around the corner and already launched in a few US markets, the speeds and the latency we're seeing are ridiculous. They're absolutely insane. And I've been writing about this for a couple of years now. You can see a couple of the postings I've done in the Globe and Mail. I co-authored a book with the CIO of Government of Canada about the impact of 5G. If we get a chance later on, we'll talk about latency as opposed to the download speeds. But the bottom line here, I've talked too long, I apologize. But bottom line is that 5G is just going to accelerate this home office trend. And there's going to be a lot of derivative implications to that.
Well, and I would suspect that the connected and autonomous vehicle sector will benefit from many of the developments in the 5G sector. So that's good. Sanjeev, you've had a long career as an investment banker, leading many tech deals over a number of years that included some severe downturns in the economy, and now you're sitting on a very successfully raised growth fund at round 13. What's your view on the current state and some of the points that were made earlier?
Yeah, it's certainly an interesting time. I'll pick at a couple of comments that Eva and Ray made, which I agree with in large part the comment, but just to kind of bring it together. We're spending a lot of time, I think, like others, thinking about how we come out of COVID, right? And what does it look like? And we reflect back on the history. So when you think back to 9/11 and other crises, and the credit crisis of 2007-8, there were scars that came out of that. And so we're trying to think of what those scars are. So the 9/11 scar, some guy decided he wanted to light his shoes on fire, and the scar that from that is now every time we go through the airport, we take our shoes off, and we kind of take it for granted. Coming out of the credit crisis, there's enhanced mortgage standards now, particularly in the US, where they don't want to lend to the same type of people that they were lending to before. So again, coming out of this, we're clearly in a COVID crisis. There's an intermediate phase as we come out of it, and then there'll be kind of this what we call what the post-COVID world is, and it may blend into it. So what's the scar that comes out of it? Is it, you know, permanently we'll have two people in an elevator? Will we be spaced out more in a workplace? So those are things we're constantly thinking of. And I think as a result of that, you kind of break down the companies you're seeing into a couple of categories, right? And maybe even a few categories. There's clearly companies that you see that are hit by COVID, and those have been negatively impacted, right? And but directly negatively impacted, I mean. And so those are the companies that would be dealing in the restaurant trade. So the touch bistros, et cetera, of the world would, you know, their client base is restaurants, and those haven't been open. Technology companies that have been touching travel obviously have been hit pretty dramatically. You know, one of the comments Ray made is really interesting because the public markets haven't reacted as such, right? And you know, Lightspeed's a great example of that, which is, you know, selling point of sale software to small businesses. Yet, if you look, their share price is exactly the same as it was prior to the meltdown, and I think that's having some impact on private market valuations, because people are looking, going, if the public markets haven't adjusted, what should the impact be on private markets? But I'll pick at a comment that Eva made, not pick at, but amplify, which is she used the word polarizing, and I think that's going to be the key element in the private market. So I don't think there's going to be a big change on the valuation of startups, but the startups that get funded will be different. And so people are, you know, certainly investors are looking for, you know, COVID resistant or beneficiaries of COVID, if you will. And so, if you know, the data is already in for this, but, you know, companies that focus on online learning, that focus on direct to consumer, that focus on automation, I'll come back to that in a second. Clearly, telemedicine, like areas like that have been funded, and valuations haven't changed on that. Where I think the bigger question is companies outside of that. So your regular, you know, run-of-the-mill enterprise software company, they've been hit right now. Their sales cycle has changed. They have, it's taken longer to make sales. What do you do with that company? What is that company where that company was growing 30% a year for the last 5 years? Their forecast this year was 30% growth. It's going to be best case flat, it's probably down, and who knows what the future looks like. To me, those are the real question marks. Like, what is that company? I'm making up a number. That company was worth 8 times revenue in the fall. That's what they're funded at. What is that worth? And I think that's the single biggest thing. When I look in the market right now, the single biggest disconnect is that company, which is they were, you know, a relative high flyer, and, you know, up to last fall or up to the spring. And what becomes of that company, and how do you value that company now? Because if you're the entrepreneur or existing investor in that company, you're like, yeah, things are a little lighter, but we're not worth what we were in the fall, but, you know, we're worth a little bit less. And if you're a new investor looking at that opportunity, you go, well, a company that's flat to down year over year, and who knows what next year looks like given the uncertainty, that's not worth 10% less than last year. That's a fundamental disconnect. And so I think that's going to be the biggest challenge. And as more and more data comes out into the market about how long the cycle that we're in lasts, then we'll be closer. Either we're coming out of this sooner, in which case, sure, maybe you are worth closer to what you were in the fall, or maybe this is going to be way longer, and it's going to take a lot longer, and you're not worth anywhere near where you were worth in the fall. So I think that's going to be the biggest, most interesting thing to come out of this.
Interesting. I take from all of your comments that it's too early to tell. You know, as to what the normal, how things will get normalized in the new normal, whatever that's going to be. But at the same time, there is capital available. It needs to find a place, to find a home, and there are some amazing, incredibly innovative companies in Ontario as well as across Canada, and I'm hoping that there will be a convergence of money and the companies that are looking for it. Having that, you know, that in mind, I'm just going to sort of skip ahead a little bit and ask for advice, right? So I'm Shiva, right? Or somebody aspiring to be like Shiva, who's actually, you know, achieved quite a bit already. I'm an entrepreneur. I founded my company. I'm in this space. What words of advice can each of you as investors give? And I would include Shiva in that because you've got the experience. You're in the middle of raising some money now. You know, is it realistic to be able to get a term sheet, for example, without in-person meetings? Obviously, in-person meetings are not possible, or they're extremely limited if there are any. How effective are virtual meetings in order to deepen the conversation? How do you develop a robust understanding of each other and your mutual objectives? So, I mean, those are just some of the questions, but what words of wisdom and advice can each of you give to our founder audience? Starting with you, Shiva.
Yeah, I think from my experience, it's the relationships that you've been building over time, over a longer period of time than just when COVID hit, are going to be critical to that. Looking at potentially, well, in my case, was looking at strategic investors as well. So are there, even with corporations in automotive getting hit very hard with COVID, positioning ourselves as, you know, an answer to their future for during a time like COVID in the future, how would they mitigate such issues? What kind of business models do they need to focus on? But also at the outset of it, what do they think the market trends are going to be pushing towards and what's important to them? And by having that alignment, we've been able to go down that path, and we're very close to getting to that finish line. But it was corporate strategic alignment was one thing we focused a lot on, and then our existing relationships with investors to kind of follow on and support the round.
Great, thanks. And that's great if you have some existing relationships with investors. Perhaps you've, you know, pre-COVID been talking to investors. You've developed a rapport. You may have existing investment from one or a number of venture investors, and now you're going for for what's the next round. But, you know, so turning to you, Eva, is there anything you can give by way of advice to companies that are coming at this fresh, who are really having to meet the challenge of, engaging with new investors for the first time? What would you give by way of advice?
I actually have three advices, that I think, for those entrepreneurs on the call will find very helpful. As I was saying, I helped my husband to build his company during the early days. So I remember how hard it was for us to raise funding. And we were literally on the verge of selling our house to continue to fund my husband's dream. So I knew how hard it was to be an entrepreneur. And in that context, I'm giving you three advice, while I'm trying to, protect my friends in the community as an investor, but I really also want to be, seeing the entrepreneurs to be successful. So there are three things. First of all, don't raise money unless you need to. So it's kind of contradicting that a lot of people thinking that, oh, I have an idea, why don't I go get people to fund me and get started? No, I think right now in this climate, it's ultra important that you bootstrap as long as you can. Because right now a lot of VCs, or I should say investors, are really hunting for deals, me included. And I think it's, you don't necessarily want to, dilute your company too early on unnecessarily. So if you can actually be very resourceful, get non-dilutive funding, grants, loans, whatever, your own sweat equity, or get friends to work for you for free. Those are all the vehicles and levers that you should pull before you go ask for funding. So that's number one. Second of all, now that you have moved from the stage of, yes, you have got some traction, you have got a good business plan, and you think that you are ready to raise funding, then the next thing that I really want you to remember is transparency. COVID has changed dramatically. I would say, I don't know if Ray is seeing the same thing, in terms of collaborations among VCs. In the old days, before COVID, everyone had their own pipeline. Everyone are actually, dealing with their own investment opportunities. Sometimes we bump into each other and we casually talk about, hey, have you talked about this company? Have you seen this? And then the collaboration always happen but it's more casual. It's not systematic. Now with COVID, everyone have no choice but to actually do online calls. VCs are now more collaborative than ever because we don't have the opportunity to actually meet the entrepreneurs. So we rely on everyone to collaborate far more often. So some VCs, they even have regular calls these days on a weekly basis, monthly basis, bi-weekly basis, to kind of like, what deals are you seeing? Have you talked to Shiva? How do you like Shiva's idea? What's weak, what's strong? We talk about it all the time. All these back channeling, it's happening whether you want it or not. So you better actually be upfront and be transparent and say, say Shiva is pitching to me and pitching to Ray. Be transparent about it. Say, yes, I'm talking to Eva and I'm also talking to Ray. You want me, you guys, do you know each other? Maybe you guys can talk a little bit more about my opportunity as well. So all of a sudden you give the the VC a lot more confidence that you're fearless. You have nothing to hide. You are here to kind of like put on a good show. And if you want to scrutinize me, be my guest. And that kind of confidence to come across rather than, oh shoot, I screwed up this meeting with Eva. Don't let Ray knows about it. Chances are they will find out anyway. So you better be upfront rather than kind of like be, secretive if that's, you feel confident enough to do that. Now, the last thing I actually want to talk about is to actually touch on Shiva's point of strategic investment. I don't necessarily recommend that to come in too early, especially if you're in pre-seed or the seed stage. I've seen enough companies that during the early stage, when they bring in a strategic, sometimes the strategic is really just strategic, thinking of how you're going to be able to help them. So if they put in too big of a check during the early stage, they may actually look at you as a low-cost contractor, that's not on the books. And they will try too hard to sway your company to help them rather than help you to build an independent company. So that's the balance that you walk on. And that's why I suggest, strategic usually should come in more in a post A or maybe even B round, so that you have your own footing, your own identity created, and not easily be swayed by the others. So 3 things from me.
Yeah, good point about the strategic investment. I mean, it can be hugely beneficial, not just from a financial investment standpoint, but being able to leverage the larger player, the big company coming in, you leverage their brand, as well as some of their network and so on and so forth. But on the flip side, you're right. I mean, you do end up giving up some opportunities, sometimes some IP rights, sometimes some market distribution rights, and so you definitely need to weigh that carefully. Ray, you've got both challenges, right? So you've got this portfolio of a number of companies that you've invested in, and then you've got new companies coming to see you who want your attention. How do you do this? Do you compartmentalize this in your mind and say, well, I'm going to be more focused on doubling down on some of our existing investments and not really be all that attentive to new companies, or are you spreading yourself across both, or how do you deal with this? And what advice would you give companies in both compartments?
It's a good question, and unfortunately, if you bifurcate that question into 2, the advice for VCs, I know that wasn't the question, but the best practices for VCs are to focus on the companies that are doing well and help them do even better. It's human nature to help the companies that are struggling and to help them turn around. And I know that's altruistic, and that's what everyone on this call would agree with is something that should be done. But unfortunately, you don't see a lot of turnarounds, especially in tech startups. You don't see a lot of turnarounds in early stage private tech companies. There's almost like a karma of the company itself that takes hold. I also want to go back to what you were asking earlier, because there was a couple of interesting things there. We're doing a pretty large size financing where Wells Fargo and Credit Suisse are leading it. They've been updating us on a regular basis about the Wall Street roadshows. Now, what they said, Manoj, is that they said the Zoom type of roadshow is going to permanently change the way financings are done, especially if you're an established public company and you're a known entity. It's just so much more efficient versus going to Minnesota for 2-3 meetings. I used to go to Winnipeg to meet 3 accounts. They're just getting so much more done, and people have established the culture of it. It's like if a dog barks in the background, now people don't care. It's just part of the culture of the Zoom meeting. Having said that, like Eva was referring to this collaboration between VCs, when we're funding companies, especially we're funding early stage companies, it's really hard not to want to meet them. And, you know, we're going to get there soon. It's any day now. And, you know, Ontario's, everyone's opening up. So the personal meet and greet is of relevance. You know, I would say one thing is that it's absolutely harder to raise money in this funding environment. If we ourselves as like VCs have to raise funds. Now, I would love to hear, you know, Sanjeev's point on this, because he raised a huge fund recently during this difficult environment. So or maybe it was just preceding the environment. That's very rare. We raised our first fund in the middle of the financial crisis. But it's different. Like my LPs were in institutions. I have 6 investment banks CEOs as LPs. I'm the largest LP across my funds. Very different type of situation versus a traditional fundraise. In terms of like, how do you go about raising in this environment? You know, one of the things I really would encourage, especially if you're early stage, is to try and like line up the sales side ahead of the dev side. Now, you know, 10 years ago when apps were new and stuff like that, you know, the focus was much more on the dev environment. These days, pretty much anything that you can imagine to be developed can be developed. And so the limiting factor now is sales development. We funded a company called Digit. It, you know, it has about 60 billion assets under management, one of the largest fintech companies in the country. We funded them. We led their seed round, and they had just a PowerPoint deck. They went out and signed up a big institutional investor for their service before they even had a product. Now that's unusual. I'm not saying that that's typical. That's very unusual. But if you can do sales development before you do product development, if you can line up customers, that's so amazing. Because to Eva's point about bootstrapping, man, if you can get to profit, if you can get, you know, become independent of outside financing for your growth, I think it's a different day and age. When you're on the, you know, we had 11-year bull market cycle that was the largest and longest bull market in the history of the capital markets. Now, when capital is freely available, interest rates are next to zero, then, you know, you have a different type of situation. You know, you become like a company like WeWork, where your revenue is 2 billion and your losses are 2 billion. Okay, so you're going to go out and just spend money like it's freely available. I apologize. I got something happened in the background. Maybe Manoj, I'll just wrap up on that point, just so you guys don't have to listen to this alarm. So speaking of the dog barking in the background, I guess this is a fire alarm. But I had a couple other points. So what I'll do is I'll just text it out, Manoj. I made some notes when you asked the question, so I'll just text it out to the group. Sorry about the background noise. Yeah,
no worries. It's par for the course, as they say. Sanjeev, you've obviously had, as I said before, experience in advising and companies and acting as their banker in your previous roles in some very difficult times. And now you've got this very significant fund that you've successfully raised money for. What's your take on this point? What advice can you give?
Yeah, listen, I think this is going to be a really interesting point. The whole, can you make an investment in a company without having met the team in person? And I'm of two minds of it, to be perfectly honest. On one hand, we've been fortunate that all the situations we've been looking at, we have pre-existing relationships because we've been around the market a long time. We know somebody on the board, we know somebody in the management team, and so even though we're doing Zoom only meetings right now, we feel a comfort level because the people we're talking to are people that we've in some way known. So that on one hand, that's good. But on the other hand, I worry that, are we reinforcing the same kind of biases, right? We're only meeting people that we know in some way through that network. And are we not exposing ourselves to new people? So I do worry about that. The advice I'd give is the opposite of that, which is if I was a CEO of a company coming through, I think about these longer term relationships, because it is hard. As much as we say the Zoom world's great, and it is because it saves a lot of time and effort. There is unconscious bias that people feel like they want to meet somebody. They feel like, hey, if I meet somebody in person, I can look them in the eye, and I can. There's still that kind of old school mentality in it from a lot of people, myself included. And so the advice I'd give goes back to building those longer term relationships, and even I 100% agree with Eva, by the way. Raising money only when you need to raise money, not just, I think a lot of companies just go, well, it's time for my seed, it's time for my A, it's time for my B, and that's just part of the cycle. And I've never quite understood why that is. And if you can, raise money when you need it, but recognize that if you've got a plan where you're going to require money, you might be accessing money a bunch of times, and you might want to build those relationships in advance. I've always found it bizarre that companies, particularly companies that are fortunate enough to have multiple term sheets, they kind of run these processes, and then they kind of they do a bake off, and they go, oh, I got 10 term sheets, and then I picked this one, I jammed this US VC, and now I got this VC on my board. And then it's like a shotgun wedding. Like they didn't know these people beforehand, and now they own 30% of their company, and then they complain a year and a half later, going, "Oh, they stuck this 26-year-old MBA on my board, and now I worry about this, I worry about that." And I always look at them kind of going, "Well, what did you expect? You had no relationship with these people beforehand. There's nobody on your board. Nobody knew these people, and now you did it because you thought you could. It's a good name brand to get, and now they've got a different priority than you." And I always kind of shake my head at that situation. And again, it keeps coming back to that point of building these longer term relationships so that you know who you're getting into bed with, and you have a comfort level with that when times are good, things will be good, but when times are bad, you know who you're dealing with. And so that's the single biggest thing I would say is, and push your existing partners, whether that's seed investors or early stage VCs, to make those recommendations. Everyone should be adding value, or who's around you. So your legal advisors, like, push them to make those representations, and tap that network that's existing, because in this time it is difficult to raise capital. And I think understanding where those linkages are to other people in your network is going to be critical.
Well, look, I mean, I've got 4 ideas as to who I would select to advise our founder-led companies to go to, if it makes sense to all of you. Let me say one thing. Look, it's certainly good advice that you're all giving, that companies maybe shouldn't be raising money, at this time, and take advantage of, other funding programs, maybe non-dilutive, sweat equity, et cetera. And that, that strikes me as good advice. But, in my experience, our companies, clients of ours that have raised money, it always takes 3 to 6 months in normal times to get to the commitment stage and close. I assume you're not advising companies to stop making those efforts, rather just to kind of, you're managing their expectations, as they say, in terms of when to secure financing. Maybe defer the discussion about valuation till there is this new normal. Does that make sense to any of you, or are you saying just take your foot off the pedal completely and don't worry about, well, not don't worry, but don't focus on funding right at this moment?
I think, as a CEO of a company, their full-time job is actually fundraising. And I think this is something that I want the audience to leave this meeting about is, as a CEO, a successful one, your number one job is to make sure that, there's cash in the bank so that you can continue to run this company. So what that means is, should you stop talking to VCs? Of course not. But should you be actively hunting for a term sheet? Not necessarily. I think, for any, sophisticated VCs that have been in a market long enough, they basically want to hear a story of how are you actually running the company if you continue to have to limp, and how are you going to limp, moving forward. So as a CEO, you need to be able to kind of like be very aware of where you're at with the books, product development, sales cycle, when money is coming in, yada, yada, yada. But at the same time, paint a picture, to the investors of how you're going to bring the company forward to be a ginormous one, an ultra successful one, and making also the investors successful. And that conversation is not going to happen in 6 weeks. That conversation is going to happen, in my opinion, bare minimum 2 to 3 months. So especially if you're trying to hunt for a term sheet, you know, that's getting more and more difficult. So start engaging when you have people say, hey, you know, you are doing this, you should talk to this VC because they have the portfolio looking for this kind of company as well. Then, you know, just have a conversation. You don't have to say, I'm raising. You say, hey, you know, I know that you have been in this space long enough. You guys have portfolio companies in this industry. You know, just want to kind of like be on your radar. You want to have a, you know, you want to get to know about us. That's the start of a conversation. Just say, I want to be on your radar. Let's just start the conversation. There's nothing wrong with it.
Great. So we have precious little time, only 3 minutes left, and I do want to make sure that we invite Rayad Kadri from AVIN to say some concluding remarks. But just and unfortunately we have run out of time for Q&A, but I'll take one question. I'll just read it out to you for, this is with regard to EV, electric vehicle, I presume, and AV will require considerable infrastructure investment, which is completely different than investing in software startups. How will VCs work with infrastructure startups that are, you know, as Andreessen said, it's time to build, to be specific, DC microgrids for EV charging, new edge networks for low latency communications. Any of you?
It's what
I'll make a quick comment about it. Like, I actually don't think that's a VC game. That's big dollar amounts. That's infrastructure spending. That's a PPP. That's a partnership with government, and that's pension fund. Like that's who needs to get behind that type of initiative. To be perfectly honest, so you know, I'd love to say, hey, we'll all throw dollars into that, but you know, the type of dollars we're talking about that to get those kind of initiatives going, which are great initiatives. But they're different pockets where that money comes from. Personally, I believe.
Ray, quickly, do you have something there? Yeah.
Yeah, I violently agree with what Sanjeev just said. It's unfortunate, but you know, oh, there I go with the alarm again. So I'll just leave it at that.
All right. Look, we're almost out of time, but we just want to give Rayad Kadri from AVIN a quick word or an opportunity to provide a quick word and sum it up. Rayad, you there? There we go.
Hi, everybody. Can you see me? Can you hear me?
Absolutely. Take it away.
Fantastic. Thanks, everybody. And thank you, Manoj. I just want to take the opportunity. I'm Rayad Kadri. I work on the AVIN team at OCE. I want to take the opportunity to thank BLG for partnering with us on this series and bringing together a group of insightful panelists that have really, it's been a very good discussion and almost want to extend it for another hour. But I feel like Ray's alarm is not going to let him get a couple words in. As Mona mentioned earlier, AVIN is the Government of Ontario's initiative for the future of the automotive and mobility sector in Ontario. It's making sure that Ontario continues to be a leader in technology in this sector, and as well as not only the commercialization, but also the adoption. So just wanted to mention again that it was the initiative by the Government of Ontario, and it's run by OCE. And thank you all. Thank you, Manoj, for being a fantastic moderator with very great questions. And thank you to all the panelists for all your, like I said, very insightful comments and messages. And hopefully, you know, next time we schedule it for 2 hours to hear more about what you have to say. I think if there's any questions, we can probably send it directly to the individuals and maybe get back to anybody with questions going forward. But again, thank you everybody for joining. Thank you, Manoj and BLG, and tune in next time.
Thanks, everybody. Thanks, panelists, and thanks, audience. Stay safe.
Thank you.
Bye.
Bye for now.